Hey everybody, and welcome back to another episode of The Mortgage Musketeer, where today I'm going to be talking about the APR, or the annual percentage rate. What does it mean versus the interest rate? Okay, so I'm going to make this super simple, and this is what you need to know. The APR is not your interest rate. I say again, it is not your interest rate. So get that out of your mind, okay? It is a representative interest rate for some of the costs of a loan. Not all of the costs, but some of the costs. Therefore, it doesn't really bear as much weight as people would think it would be. People see the APR, think it's like a credit card. It is not. Your interest rate is your interest rate, period. Your APR is certain fees that are rolled in and amortized over 30 years to give you kind of a picture of what the cost of those would be. But understand that the cost of the loan, there are many fees that go into it. There's all your title fees, there's your escrows, there's property taxes, there's homeowners insurance, there's appraisal, and on and on and on, right? And only certain fees actually go into the APR fee. You know, a lot of things like underwriting and points and things like that, those are APR fees. Your mortgage insurance, if you have mortgage insurance, that's included in the APR fee, all right? But that's a separate payment. It's not actually an interest rate. It's just the APR is designed as kind of like it's supposed to allow you to go and kind of comparatively shop, but it doesn't always work that way. And the reason it doesn't work that way is because people don't always mark their fees appropriately. Okay, so I'll never forget when I was a young loan officer and I was competing against another lender, and this gentleman was telling me how my loan was not as good as what the other one had. I had no points. I had the same exact interest rate, no points at all, right? And there's no possible way that the other person's APR was higher. We didn't have any mortgage insurance, but it's how they had marked it up. It made it look like it was a better loan, but the other loan actually had points and fees in it, right? So, that was so frustrating, and I didn't know, because I was too young at the time to understand how to combat that. And this is what I'm going to tell you, and this will make it really simple. So, all you have to do to cut through any lender's BS is say, hi, if I lock this loan with you today, what will I find on page 2 of the loan estimate in section A? Because that's where your fees are going to be. Every other section in a loan estimate is going to be the same, because title fees are going to be the same no matter who you use. It's a title company, right? So whether you choose lender A or lender B or C, lender C or B, it's going to be the same. Whether you're going to find your own homeowners insurance, so that's going to be the same. They're going to find out what the property taxes are. That's going to be the same. I mean, everything else is going to be the same because there's no difference in who you're actually using no matter who you close with. But what will change are the items that you'll find in section A, page 2 of the loan estimate. And that's how you can actually figure it out. Now, there are some fees that are very normal, like underwriting fees. Very normal to have those in there because somebody has to pay for underwriting the loan. That's just the way it works. But other things like administrative fees or points, points might be worth it if you're going to be in the home if it's like your forever home, okay? Those are conversations that you need to have with your loan officer to understand the cost of money over time. Otherwise, if you know your loan is going to be in there for a couple of years, the points may not be worth it. But again, consult your loan officer. They should be able to break down a recapture value and what is it going to take for that to be worth paying points to buy a rate down. So, knowing all of that, there are certain fees that go into the APR, okay? And to include the mortgage insurance, all right? So know that just because you have mortgage insurance doesn't mean that it's a bad loan, but it might make your APR reflect higher than if you didn't have mortgage insurance. But understand that that's not your interest rate, okay? And that's where people get confused. They see, oh my gosh, my APR is really high. Well, it's not, all right? Because the way that your loan is structured, you may require mortgage insurance, or you may be in a loan product that requires mortgage insurance. Most people aren't in mortgage insurance for the life of the loan, but that's what it's trying to represent. So it's not really accurately reflecting, right? So keep those things in mind. And I circle back to the very first thing I said. Your interest rate is not the same as your APR. Your APR is not your entire loan's interest rate. Most of those fees, if not all of them, are all paid at closing anyway. So any of those representative fees that are showing the APR higher are either paid at closing by the buyer, and sometimes they're paid by the seller. If all of your fees were paid for by the seller, you still have the same APR, even though those fees went away. All right, so that's why you cannot use your APR to really do comparative shopping. Should you have been able to? Sorta, but it doesn't work that way. All you need to worry about is what is your actual interest rate and what is in Section A, page 2 of the loan estimate. You do that and you'll be straight. And that's how you can easily kind of cut through any questions about what is your actual rate or how good is the loan. All right. Hope this is helpful. Do me a favor. Hit the subscribe button. Help me grow my subscriber base. Lets me know that what I'm doing out there, people are getting some good information. And if you have any questions, leave comments below. And until next time, it's all for one and one for all.